Good afternoon, boys and girls. Welcome to the Liberty Call for Thursday, June 16th, 2022. Another bloodbath day in the market. The positive vibes that we had after yesterday's rate increase, I guess they went away overnight. Crazy, I know. But if you're out there and you're worried about what's going on, give me a call. All my information's on the website, dsafinancialgroup.com. But let's go ahead and jump into what's going on today. Let's see here. The major indexes here in the U.S., the Dow Jones closed down 2.42% at 29,920. First time it's gone below 30,000 in quite a while. S&P 500 was down 3.25%, closed at 3666. NASDAQ was down 4.08%, closed at 10,646. Small caps were down almost 5%. The VIX was up 11.24% today, sitting currently at 32.95. Canada finished down 3.1. Brazil was up 0.73. Mexico down 1.63. Moving over to Europe, let's see here. Germany down 3.31. UK down 3.14. France was down 2.39. Euro stocks was down 2.96. Netherlands down 3.75. Wow. Spain down 1.18. Italy down 3.32, Switzerland down 2.86, Portugal down 2.06, Belgium down 2.81, and let's go ahead and move a little further down. The Russian markets did pretty good today. The MOEX was up 2.19, while the RTSI was up 2.84. Let's head on over to the Asian markets. Japan finished up for the day, 0.4. Australia was down slightly, down 0.15. New Zealand finished up 0.17. Headed over to China. The Shanghai was down 0.61. The SESC component up 0.11. China A50 down 0.84. The DJ Shanghai down 0.59. And the Hang Seng finished down 2.17%. And the Taiwan weighted came in down 1%. So kind of a mixed day in parts of the world. But looks like Europe and the United States really took it the worst. So, is what it is, folks. I mean, I've been, if you've been listening and playing along and watching these videos on a regular basis, you know that this is not a shock. So, all right, well, let's go ahead and read through today's market recap. Dow closes below 30,000 on doubts Fed will avoid a recession. I wasn't sure that they were going to. Let's see here. The Dow closed below a key milestone Thursday and slipped below a more than 1 year low as the post-Fed surge quickly faded on worries that avoiding a recession is likely out of reach. Investors appear to be bracing for growing possibility of a recession on concerns that the Fed to turn even more hawkish because inflation will remain elevated for longer than the central bank currently expects. Really, folks? I mean, come on. I could have told you this last summer. Quote, bottom line is the Fed still believes core inflation is largely temporary, end quote, Morgan Stanley said, pointing to the Fed's forecast for core inflation to peak at 4.3% this year and eventually drop under 3% next year. But with inflation currently running at 8.6% in expected by traders of fixings or derivative-like instruments to remain above 8% for the year, the Fed may be forced to hike rates to a terminal rate or peak of 4.5% to 5%, more than the central bank's current forecast of 3.5% to 4%. Despite the slip in Treasury yields, post-Fed decision, Morgan Stanley said it believes the yield curve will soon resume flattening and invert, a key recession warning, as markets, quote, move toward a higher terminal rate, end quote. Tech and consumer discretionary, the growth areas of the market, gave back their gains from a day earlier, with the latter led by a slump in consumer stocks on worries about Fed-induced slowdown pushing the economy into recession. Royal Caribbean cruise lines, Norwegian, Carnival were among the biggest decliners, with Tesla while Tesla slumped 10% to pile on the pressure in the sector. Big tech, meanwhile, was also shunned with Facebook, Apple, and Amazon down more than 4%. KLA Tencor Corporation gave up earlier gains to add more pressure on chip stocks, even as it reiterated its guidance for current quarter and announced a new $6 billion stock buyback program. Economic data on Wednesday exacerbated fears of slowdown The housing market continued to run out of steam as data showed housing starts, a measure of U.S. home building, fell to a 13-month low as mortgage rates climbed. Home builders stocks were quick to react to the data. Toll Brothers, Lennar, Pulte fell more than 6%. With the Fed's balance reduction plan underway, which includes selling mortgage-backed securities, housing remains the proverbial canary in the coal mine. Its song is getting softer. In quote, Yelena Malayev, an economist at Grant Thornton, said in a note. So yeah, it's not real good. All righty. Let's go ahead and jump into some news on the oil front. Oil up on new U.S. sanctions on Iran as Biden Saudi prince meet looms. Oil prices rose strongly for the first time in a week after the United States announced new sanctions on Iranian oil ahead of President Joe Biden's tentative visit to the Middle East to meet with Gulf leaders, including Saudi Crown Prince Mohammed bin Salman, who's an arch rival of Iran's mullahs. Boy, those people love to fight. New York traded WTI, the benchmark for U.S. crude, settled up $2.27 or 2% at $117.58 a barrel. It had tumbled as low as $112.33 earlier, responding to the largest U.S. interest rate hike in 28 years by the Federal Reserve a day earlier. London traded Brent crude, settled up $1.30 or 1.1% at $1.1981 after sinking to $1.15 earlier. Thursday sanctions against Iran, built on past sanctions against Trilance Petrochemical Company Ltd., which was sanctioned in 2020, and Petrochemical Commercial Company, which was sanctioned in 2018. According to the Treasury Department, these two entities are, quote, instrumental in brokering the sale of Iranian petrochemicals abroad, end quote. The move against the network of Iranian petrochemical producers and companies in China and the UAE fronting them came as negotiations headed to nowhere between Tehran and world powers to revive the deal that aims to restrict Iran's nuclear ambitions for the chance of letting it resume its petroleum exports without U.S. sanctions. Quote, the United States is pursuing the path of meaningful diplomacy to achieve a mutual return to compliance with the Joint Comprehensive Plan of Action. Let's see. Absent a deal, we will continue to use our sanction authorities to limit exports of petroleum products, and petrochemical products from Iran, Brian Nelson, U.S. Treasury Undersecretary for Terrorism and Financial Intelligence, said in a press release. Missing was, of course, the political timing of the whole thing, which came just weeks ahead of Biden's tentative Gulf visit and meeting with Saudi Crown Prince, Saudi Arabia's king in waiting, commonly referred to by his initials, MBS. Just a couple of weeks ago, Biden had played down the prospects of a meeting with MBS during his 2020 campaign for the White House. The president had pledged to make Saudi Arabia a pariah for the apparent role played by the kingdom and its crown prince in the 2018 murder of Saudi-turned-U.S. resident Jamal Khashoggi, a columnist with the Washington Post. Khashoggi had been critical of MBS. Biden kept up with his stance against the Saudis and the Crown Prince for almost 18 months after coming into office in January of 21. But record U.S. gasoline prices this year due to a global squeeze in oil supplies and falling popularity among potential voters ahead of the U.S. midterm elections in November appears to have softened the president's resolve. Yeah, they're going to get clobbered in November. MBS needs unequivocal U.S. support for Saudi Arabia in the Yemen war and for Biden to address Gulf concerns about Iran's missile program and its regional proxies. The White House earlier this month praised MBS for helping secure an extension of UN brokered truce between Yemen's warring parties. Biden, in return, simply needs more oil from OPEC, the 13-nation organization of petroleum exporting countries led by Saudi Arabia. A mere nod from MBS would allow his kingdom, which effectively controls OPEC and its 10 oil-producing allies, including Russia, to open their oil spigots a little more, providing some relief to American consumers struggling from fuel prices at record highs of $5 a gallon or more. Yeah, I can tell you that. I just filled up my truck and its external tank, and it was expensive. Excuse me. A senior U.S. official told Reuters earlier this week that if Biden determines it's on his interest to engage with any particular leader, and if such an engagement can deliver results, then he will do so, end quote. Yeah, I'm not a fan of doing any business with the Saudis, primarily due to the proxy war in Yemen, our involvement in probably one of the greatest genocides in the world going on right now, and we are helping it out, which is really unfortunate. So, all right. Next article, U.S. labor market appears to cool, home building slumps as rates surge. The number of Americans filing new claims for unemployment benefits fell less than expected last week, suggesting some cooling in the labor market, though conditions remain tight. There are growing signs the Federal Reserve's aggressive efforts to slow demand and bring down inflation to its 2% target are starting to have an impact. Home building slumped to a 13-month low in May, while a gauge of factory activity in the Mid-Atlantic region contracted for the first time in 2 years in June. Initial claims for state unemployment benefits slipped 3,000 to a seasonally adjusted 229,000 for the week that ended June 11th. The Labor Department said economists polled by Reuters had forecast 215,000 applications for the latest week. The decline left the bulk of the prior week's jump intact, which had lifted filings close to a 5-month high. California reported a surge in unadjusted claims last week. There were notable rises in Ohio and Michigan, potentially related to the auto industry. Claims also increased considerably in Illinois and Pennsylvania, but fell in Missouri. There has been a steady rise in reports of job cuts, mostly in technology and housing sectors. Still, claims have remained locked in at a tight range since plunging to more than a 53-year low of 166,000 in March. There were 11.4 million job openings at the end of April. The number of people receiving benefits after an initial week of aid rose 3,000 to 1.312 million during the week that ended June 4th. Quote, "For now, supply and demand mismatches will keep filings low," said Rubila Faruqi, chief U.S. economist at High Frequency Economics in White Plains, New York. Quote, "But this level could start to trend up as the Fed continues to remove policy accommodation to slow demand," end quote. Thursday's data followed on the heels of news this week on a surprise decline in U.S. retail sales in May, amplifying fears of a recession. The housing market, the sector most sensitive to interest rates, is losing speed, but this could bring housing supply and demand back into alignment and lower prices. A separate report from the Commerce Department showed housing starts plunged to 14.4% to a seasonally adjusted annual rate of 1.549 million units last month, the lowest level since April of 2021. Economists had forecast starts would slide to a rate of 1.701 million units. So, oh gosh. Permits for future home building declined 7% to a rate of 1.695 million units. A survey on Wednesday showed the National Association of Home Builders Wells Fargo Housing Market Sentiment Index hit a 2-year low in June, with the gauge of prospective buyers' traffic falling below the break-even point of 50 for the first time since June of 2020. Single-family housing starts, which account for the biggest share of home building, tumbled 9.2% to a rate of 1.051 million units last month, the lowest since August of 2020. Starts rose in the Northeast, but fell in the Midwest, South, and West regions. The 30-year fixed-rate mortgage jumped 55 basis points this week to a 13.5-year high of 5.78%. Mortgage finance agency Freddie Mac reported on Thursday. This was the largest one-week increase since 1987. Wow. Quote, "Rising rates aren't all bad news, however," said Jacob Channel, senior economist at LendingTree. Quote, "Though it's unlikely home prices will majorly slump, an increase in housing supply will likely significantly slow home price growth and give would-be buyers more housing options to choose from," end quote. Building permits for single-family homes declined 5.5% to a rate of 1.048 million units, the lowest since July of 20. Housing starts for housing projects with 5 units or more dove 26.8% to a rate of 469,000 units. Multifamily housing permits dropped 10% to a rate of 592,000 units. The number of houses approved for construction that are yet to be started increased 0.7% to 283,000 units. Housing completions were the highest since 2007, which together with slowing demand could help lower prices. Goldman Sachs trimmed its second quarter gross domestic product estimate by 0.2 of a percentage point to 2.8% annualized rate. The economy contracted at a 1.5% pace in the first quarter. Quote, "The Fed's aggressive and abrupt policy tightening," I don't know if that's abrupt, I mean, they telegraphed this since last fall, "may soon be criticized for letting in the winds of recession," said Christopher Rupke, chief economist at Forward Bonds in New York. All right, so a little bit of a slowdown in the areas that we would expect with interest rates going up. It makes the housing market not as appealing, and should hopefully help on home prices. All right, last article I got to cover today: 3 money mistakes to avoid in a bear market. All right, spooked by the bear market and worried about what's next, investors are looking for ways to shield their portfolios from more pain. Yet money moves made in fear can be bad ones, advisors and behavioral economists warn. On Monday, the S&P 500 closed more than 20% down from recent highs, officially entering a bear market. On Wednesday, the Federal Reserve approved the largest rate increase since 1994 in a bid to hit the brakes on rampant inflation. Whether the economy is in a recession or entering one is still up for debate, but concern is high among some economists and Americans in general about the path of the economy. When the economy weakens, employment rises, wages become stagnant, and spending slows. For investors, this sense of doom and gloom can prompt questionable financial decisions with investments, debts, and household budgets, said Michael Lerish, head of Wells Fargo's Advice and Planning Center. Quote, people go back to what feels good and familiar from a financial perspective rather than what actually will help them, Mr. Lerish said. Here are three common mistakes advisors say to avoid when choosing how to defend your money in a possible downturn. Panic selling. Individual investors tend to sell after an economic downturn is already priced into equity markets, said Katie Nixon, chief investment officer at Northern Trust Wealth Management. By selling at this time, investors are locking in their losses. Quote, this perfect bad timing can have negative consequences for building wealth, end quote, she said. Dana Menard, a financial planner in Maple Grove, Minnesota, knows several people who halted 401k contributions during the last recession to boost their take-home pay. Doing so may boost short-term cash flow, but people then miss out on their employer's match contributions, essentially losing out on free money, he said. People also forget to resume contributions once the market starts to recover and are missing out on gains because they've adjusted their lifestyle to a higher level of spending, said Mr. Menard. Sticking your head in the sand isn't an advisable strategy either, said Mr. Lerish at Wells Fargo. When looking, focus on how to rebalance your investment accounts by reinvesting your target asset allocation and overall investment philosophy, said David Hubner, a financial planner in Fargo, North Dakota. Use tax loss harvesting to reduce your tax liability and replace assets that are down with similar investments. Should you have extra cash on hand, take advantage of a stock market downturn to buy stocks that are trading lower, he said. In addition, by checking your balances, it is important to check your state of mind, said Betty Wang, a financial planner in Denver. How do I feel about this market? Can I stomach this future? Down markets and recessions are a fact of investing, she said. Do you need to make any changes to how or what you invest in? If you still can't sleep at night, it's time to reconsider your asset allocation, said Ms. Wang. 2, use up your emergency savings to pay down debts. Paying off credit card debt is among the best thing you can do when interest rates are rising and uncertain market conditions are ahead. But some people are paying down debts too far, said Thomas Blower, a financial planner in Grand Rapids, Michigan. If you use up too much of your savings by aggressively paying off debts with low interest rates, such as a 3% fixed rate mortgage, you could find yourself short on cash during a downturn, said Mr. Blower. Ted Halpern, a financial planner in Ashburn, Virginia, said 1 month of core expenses such as rent and mortgage payments should be your zero balance in your checking account. Heading into recession, keeping about 3 months additional expenses and reserves held in your savings account, he said. Review the liquidity of your emergency funds, said Kyle McBride, a financial planner at Betterment. I-bonds, inflation-adjusted government savings bonds, and certificates of deposit are popular because of rising interest rates, but CDs have early withdrawal penalties and I-bonds must be held for at least 12 months. People often lack lines of credit when downturns happen, said Sean Melby. It's much easier to get a home equity line of credit or personal line of credit when economic conditions are favorable, so consider securing those lines now if you're worried about the possibility of a recession, he said. It's also usually cheaper to borrow on a credit card. Number 3, spending as if nothing has changed. Failure to reassess your budget and make frequent changes can leave you unprepared to adjust your spending down during a downturn, said Curtis Crossland. Avoid spending more on non-essential items or signing up for new subscriptions and services, and look for ways to reduce optional expenses, he said. Don't add new fixed expenses, such as a car loan, if you can avoid it, he said. The idea is to keep your regular expenses as trim as possible. Many people know their income, what their income is when it comes to what they spend, but this number gets blurry, said Valerie Rivera. Write out your necessary expenses needed to cover your life and cut out any non-essentials. And waiting can pay off. During the dot-com boom in the late 90s, Tara Unvergatz wanted to remodel her house. She started the prep work, finding an architect and putting away money for the project, but she waited until after the bust in 2000 to start the work that helped her get a better price, she said. Quote, if I can't get the prices I want because the other side isn't willing to negotiate, that's usually a sign that I should wait until they are a little more hungry, end quote, said Miss Unverzatz, a financial planner in Torrance, California. So good advice there. I know I talked about earlier this week getting debts paid off, but you certainly don't want to do that at the expense of your emergency funds. And having 3 to 6 months in savings, probably isn't a bad idea right now. Also, probably not a bad idea to reevaluate your inflows and outflows through your checking account. See what you can maybe get rid of. Maybe there's things that you're spending too much money on. So anyways, all right. Well, that's everything I had for today. I hope everyone has a fantastical evening. And if anyone needs anything from me, again, go to dsafinancialgroup.com. All my contact information is there. And I hope everyone has a great evening. Bye-bye.